Disclaimer: 12 days left. That's the real number, not a metaphor, not an estimate. 12 days left before the window closes. 12 days before President Trump's executive order on European tariffs goes live and permanently alters your ability to obtain physical silver anywhere near today's prices. February 1st, 2026. That date is fixed. It isn't negotiable. At 12:01 a.m. Eastern Time, a 10% tariff is automatically applied to all goods imported into the United States from 8 European countries: the United Kingdom, Germany, France, the Netherlands, Finland, Norway, Sweden, and Denmark. And buried inside the phrase "all goods" is the mechanism that locks silver out of reach, not through confiscation, not through bans, not through regulation, but through cost, through supply. Through a supply chain failure most people don't even realize they rely on. This is not exaggeration. And by the end of this, you'll understand why 12 days left is not a scare tactic. It's a literal deadline. What you decide to do in the next 48 hours will determine whether you are holding physical metal or holding regret when the largest silver supply disruption of the modern era becomes operational reality. Let's begin with the facts most media outlets are failing to connect. On Saturday, January 18th, 2026, President Trump announced on Truth Social that he would impose a 10% tariff on 8 European NATO allies starting February 1st. The stated justification was Greenland. Denmark controls Greenland. European nations deployed military personnel there. Trump views this as direct opposition to his acquisition agenda. The response is economic pressure, 10% immediately, escalating to 25% in June if compliance does not follow. The media frames this as geopolitical drama, NATO tensions, diplomatic conflict. What they are not discussing is the commodity impact, the logistics disruption, the silver exposure. Because once you understand how silver is refined, stored, and physically transported, it becomes clear that this tariff doesn't merely raise prices, it cuts access. Here's the reality. The United Kingdom, and specifically London, sits at the center of the global silver market. The London Bullion Market Association sets standards, coordinates pricing, and oversees vaulting systems that hold the majority of institutional silver worldwide. According to LBMA data, London vaults contain approximately 200 million ounces of silver. This metal backs ETFs, sovereign reserves, bank balance sheets, and institutional positions. When American investors or manufacturers purchase silver, they usually don't take immediate physical delivery from London. They buy paper exposure, futures, ETFs, or unallocated claims. But when physical metal is required, when real silver has to move, it comes from London. Silver is shipped from UK vaults to New York, then distributed to refiners, mints, dealers, and industrial users. Beginning February 1st, every ounce moving through that pipeline from the UK faces a 10% import tariff. On the surface, that sounds manageable. In practice, it breaks the system. Silver dealers operate on margins of roughly 3 to 5%. They buy near spot, sell slightly above, and that spread covers shipping, insurance, overhead, and profit. A 10% tariff doesn't compress that margin, it eliminates it. Importing silver from the UK becomes an immediate loss. And when a business loses money on every unit sold, it doesn't adjust, it stops. So dealers stop importing. They look for alternative supply. But alternative supply is already constrained. China implemented refined silver export licensing on January 1st, 2026. Every shipment now requires government approval. Those approvals are selective. Domestic manufacturers come first. Strategic partners come next. U.S. buyers come last. Mexico is the world's largest silver producer, but the majority of its output is locked into long-term contracts or domestic use. Canada's silver production is largely byproduct metal already allocated to existing buyers, which means one of the primary supply arteries feeding the U.S. silver market is about to shut down with only 12 days left, and there is no replacement waiting. And this isn't the full extent of the problem. Germany, France, and the Netherlands host critical refining infrastructure. Switzerland, while not officially on the tariff list, is the largest silver refining hub on Earth. Roughly 60% of globally refined silver passes through Swiss facilities. But Swiss silver doesn't reach the US in isolation. It moves through European logistics routes, many of which pass through tariff-affected countries. That means the entire European refining and distribution network, which has supported global silver flows for decades, is about to become economically inaccessible to US buyers. Now look at what is already happening. Institutional capital does not wait for deadlines. Since Trump's January 18th announcement, physical silver has been moving aggressively from London vaults to New York. COMEX registered inventories have increased as metal was repositioned ahead of the tariff deadline. Millions of ounces have moved in a matter of days. This isn't speculation, it's prepositioning. Large players are paying shipping, insurance, and storage costs now to avoid paying tariffs later. But here's the critical limitation. Those movements represent only 2 to 3% of total London inventory. The remaining 97% is effectively immobile, locked in contracts, long-term storage, or simply impossible to relocate at scale with only 12 days left. Moving hundreds of millions of ounces before February 1st is physically impossible. There isn't enough vault capacity. There isn't enough insurance coverage. There isn't enough time, which means after February 1st, London silver stays in London, and American buyers are forced to compete over what's already inside the United States. COMEX registered inventory stands at approximately 51.2 million ounces. Dealer inventory across the entire retail network is estimated at 10 to 15 million ounces. Domestic recycling contributes roughly 8 million ounces per month. That leaves 70 to 75 million ounces of immediately accessible silver. Now compare that to demand. U.S. industrial consumption alone averages 140 million ounces per year, or nearly 12 million ounces per month. Add investment demand, coins and bars averaging 6 million ounces per month. Add ETF inflows averaging 4 million ounces per month. Total monthly demand approaches 22 million ounces, 70 million ounces of total accessible supply versus 22 million ounces of monthly demand. If European supply is disrupted, as the tariff guarantees, the math collapses rapidly. Within 3 to 4 months, the U.S. silver market enters a structural deficit. At that point, premiums do not drift higher. They accelerate vertically. Once the European supply channel freezes, silver does not behave like a normal commodity anymore. This is the mistake most people make. They assume shortages lead to gradual price increases, a slow grind higher, a few dollars added over time. That assumption only applies when supply can respond. Silver can't. Silver is not oil. You don't turn on more wells. It's not wheat. You don't plant more acreage. It's not tech. You don't scale production with software. Silver is a byproduct metal. Roughly 70% of global silver production comes as a secondary output from mining, copper, zinc, lead, and gold. That means silver supply is dictated by demand for other metals, not by silver prices. Even if silver doubled overnight, miners wouldn't suddenly produce more of it. The production curve is fixed in the short and medium term. That's why supply shocks in silver don't resolve smoothly. They snap. When physical availability tightens, the price doesn't rise to balance demand. Instead, availability disappears, and price resets violently afterward. We've seen this pattern before. In 2008, during the financial crisis, paper silver collapsed with everything else. But physical silver vanished. Dealers ran out. Premiums exploded. Spot prices became meaningless because there was nothing to buy at spot. In 2020, during the pandemic lockdowns, futures prices briefly crashed. Yet physical silver premiums surged over 100% in some cases. Again, price didn't reflect availability. What's coming now is larger than both events, because this time, the disruption isn't panic-driven, it's structural, and it's policy-driven. Once European silver becomes uneconomical to import, U.S. buyers are trapped inside a closed system. That system consists of COMEX inventories, domestic recycling, whatever inventory dealers already hold. And every participant inside that system competes for the same shrinking pool of metal. Here's what happens next, step by step. Step 1. Dealers pull inventory. As soon as replacement supply becomes uncertain, dealers stop selling aggressively. They widen spreads. They limit order sizes. Some quietly pull listings altogether. This isn't greed, it's survival. If a dealer sells silver today and cannot replace it tomorrow, they risk being out of business in weeks. So inventory tightens before prices move. Customers notice delays. Ships in 2 to 3 weeks becomes ships when available. Back orders grow. Step 2. Premiums. Detach from spot. The spot price of silver is determined primarily by paper futures trading. That market is leveraged, financialized, and disconnected from physical flows in the short term. Physical silver pricing, however, is set by availability. Once inventory thins, premiums rise independently. $5 over spot becomes 10. 10 becomes 20. Eventually, the spot price stops mattering at all. You don't ask, what's silver trading at? You ask, can I even get it? This is where most retail investors freeze, waiting for confirmation, waiting for headlines, waiting for price signals that arrive too late. Step 3. Industrial buyers enter the market. This is the phase that retail buyers never see coming. Silver is not optional for industry. It is essential for solar panels, medical equipment, military electronics, semiconductors, EVs, and power grids. Industrial users don't buy silver because it's cheap. They buy it because without it, production stops. When industrial buyers sense tightening supply, they do not wait for better prices. They lock in contracts. They pre-purchase inventory. They outbid investors. An electronics manufacturer can pay $50, $70, even $100 per ounce if it prevents a billion-dollar production halt. A retail investor cannot compete with that, so when industry steps in, available silver disappears overnight. Step 4. Paper markets crack. As physical shortages grow, confidence in paper claims erodes. ETFs rely on custodial silver, much of which sits in London vaults. Futures contracts assume deliverability under normal conditions. When delivery becomes expensive or impossible, the paper market must either settle in cash or reprice violently to attract physical metal. Neither outcome is orderly. This is where silver stops acting like a commodity and starts acting like a monetary asset under stress. Gold moves slowly in crises. Silver explodes, not because it's safer, but because it's thinner. A relatively small amount of capital can overwhelm the silver market. There simply isn't enough metal available to absorb demand once confidence breaks. Step 5. Retail is locked out. By the time mainstream media starts talking about silver shortages, the window is already closed. Dealers post out-of-stock notices. Mints suspend production. Secondary markets dry up. People with silver don't sell. People without silver can't buy. And those who waited for confirmation are left watching price charts they can't act on. This is why timing matters, not because of price, but because of access. Once supply chains break, money alone doesn't solve the problem. Why this event is different. Every previous silver squeeze was driven by panic, speculation, or financial crisis. This one is driven by policy. Tariffs don't reverse overnight. Logistics don't adapt instantly. Refining capacity doesn't relocate quickly. Even if tensions ease later, the damage is already done. Contracts are rewritten, supply chains rerouted, trust broken. And when trust breaks in commodities, it doesn't come back cheaply. Silver's role in the financial system is changing. Central banks accumulate gold quietly. Governments weaponize trade. Industries scramble for critical materials. Silver sits at the intersection of all three. That's why this moment isn't about predicting a price target. It's about understanding positioning. You either secure physical metal before availability tightens, or you become a price taker afterward. There is no middle ground. If this breakdown helped, like the video. For clear, data-driven market analysis, subscribe to Economic Records so you don't miss what's next.